Welcome, everybody. We're hope you're healthy and safe and taking care of yourselves. We're happy that you're here. We're happy that we can connect with you like this. Based on the chat room, I think we're beginning to get a handle on this, and we're all obviously getting a lot more comfortable communicating via screen rather than eyeball to eyeball. So welcome. We're glad you're here. And again, we hope you're all right. Technicians like us think we can give reassurance by showing you how smart we are. And we're not going to do that today. We've made a concerted effort to try and stay simpler. So if we don't cover something, as always, please ask a question in the chat box, or I'll turn it over to Sharon in a minute to tell you how to ask questions or remind you for those who were on here last time. A bull market is defined by an increase in market value of at least 20%. A bear market is marked by a decrease in market value of 20%. Well, based on last week, and the title of our call is "The Bear Market Really Over?" When we had a 20% increase over 3 days, we had the shortest bear market ever. But as you'll hear, we're probably not done. We don't know, but we think there's probably more volatility in store moving forward. Today, I'm joined by my co-pilots, Clayton Quamme and Sharon Head. I'm happy to have them here. We want you to ask questions. We select these topics, but we want to know what's on your mind. That's the point of doing what we're doing here. So please ask questions. There's no such thing as a stupid question, and we've got lots of time on our hands. So with that, I'll turn it over to Sharon so that you can tell our audience how they can ask questions.
Hi, everyone. I think almost everyone's been on the calls before, so you can use the chat box to send us questions, and then we'll answer those probably toward the end of the meeting. Or you can raise your hand, which you would need to find your toolbar that's either the bottom of your screen, or it could be, if you're on a mobile device, at the top of your screen, and it's the manage participants, and you go there and you'll see a little hand in the bottom right corner that you can click, and that'll indicate to us that you want to ask a question. So, and if you have any problems, just send something over the chat box and we'll see if we can help you out. Thank you.
Thank you, Sharon. Well, let's go ahead and get started. So, is it really over? Not likely. Are we over this bear market? Not likely. We still have uncertainty, and as we talked about before, uncertainty shakes the markets, and that uncertainty is not going away until we find out when exactly we'll get back to normal, whatever normal is. Just before we went on today, I saw that the governor of Georgia enacted a stay-in-place order as of Friday, so we're not exactly sure what that means, but we'll be available. As always, we have clients and future clients tuned in today. There'll be recordings of this briefing that will be available for you to review and share with others who might benefit from this information. We hope also that you'll share it via social media and other platforms. We thank you for that. We also, for our clients, we're still holding meetings via phone or via Zoom. We think it's important to do that now, so we've not canceled regular meetings. Please schedule those and encourage those who need reassurance to do the same. We're going to go over a couple topics today. Market update. Clayton's going to talk about this stimulus act and what it might mean to you. Then we're just going to do a real brief overview of what we talked about in our first briefing and also in our second briefing. That is actions and strategies. We're going to do that because we hope that it'll spur some questions that maybe we didn't have the first time. So let's go to a market update, or the best one that we know. And as I put this together, I thought about, explain to me what's going on. And so I'm going to try to do that in a short amount of time. We just concluded the worst market for stocks since 08 and 09. The quarter ended yesterday at March 31st. when we have stock market uncertainty, investors want to go to US Treasury bonds and gold for safety. And the reason for that is, even though stocks are going to grow more, they're going to have volatility as we've had over the last month or so. With gold and with US Treasuries, there's not as much volatility typically. We still have some volatility, but it's not going to move like stocks are going to. What's really interesting is that initially, US Treasuries, which is a safe haven, really didn't move a whole lot, which means people were not going so much to US Treasuries. And the way we can tell that is the yield or the return on US Treasuries. So eventually, US Treasury yields, people started buying them. And when there's a lot of folks trying to buy bonds, the interest rate goes down because there are more people wanting to buy the bonds. Lower interest rates can be paid because there's a lot of folks chasing a few assets. The other thing that was interesting is gold is often considered a safe haven in times of volatility and distress. And gold prices have gone up a little bit, but not really a lot, not typically what we've seen in the last few years. So what's unusual about this is cash. People have gone to cash. People being investment banks, individual investors, pension funds, they want cash over US Treasuries and gold. They still want US Treasuries and gold, but they want cash. So that leads to the next part. We hear a lot about liquidity. What is liquidity? And the Federal Reserve is trying to make liquidity and promote liquidity by doing various things. And it's in its simplest form, since people are going to cash, they want to make cash available because people tend to hoard cash by buying this cash and putting it in their accounts. If we don't have cash available, liquidity, and they can be somewhat synonymous in this explanation, then banks can't loan money. Stores can't go get credit. It makes it difficult. So liquidity in this thing is really about cash, about having cash available for folks, banks, for commerce to take place. So that's kind of what liquidity is. The other thing I want to touch on is last year, those of you who are clients, when we met, we said the markets, particularly the S&P, returned about 30% last year. And we said, that's not realistic. The reality for US stocks and stocks in general is an 8 to 9% return historically. So we knew something had to happen. Everything is cyclical. And so we knew a correction was coming at some point. And this probably is going to be repetitive, but we just didn't know when that correction was coming, but we knew it had to come. We certainly didn't know it would come this fast, and we certainly didn't know it would come as a result of the pandemic. But the markets are going to find their level, and they're just finding them very quickly right now. How are we approaching this market, and when do we get back in? Well, we had an emergency investment policy committee meeting yesterday, where it was a great meeting where we all get together and we talk about where we are, what we're invested in, how it's doing, how we go forward. And we've decided that we're comfortable erring on the side of missing part of a rebound rather than getting in too quickly. We think that there's a lot of volatility still ahead, and our clients have good investments already. So if we miss a little bit on the upside, we're going to be okay. But we'd rather err on the side of caution rather than accepting the risk of rushing back into the equity markets prematurely. So I hope that gives you a little bit of our view on the market and what's going on. We certainly don't pretend to know what's going to happen tomorrow or the week after or anything like that. But any questions on what we're thinking and what we're doing, please don't hesitate to ask in the chat box or contact us in some way. With that, I'm going to turn it over to Clayton for a section on what the Stimulus Act means to you. So.
Thanks, Gene. I think we can hit one more slide.
Oh, yep, there we go.
Boom, there we go. So we did want to spend just a little bit of time talking about the stimulus package. It was a huge topic, of course, last week. And just, I think you have to start this discussion with a disclaimer that, no one has all the answers right now. It's a big package. It's 600 to 800 pages of information. Everyone is working to digest the information as best they can. There's a lot of questions that are unanswered and will, hopefully be answered as all this unfolds. What we want to do today is just go through the key points and pieces that apply to individual financial planning. So there's a whole separate side of this for small businesses. So if there's any small business owners or some or have friends, let them know to reach out, and we're happy to answer questions on that part of it. But this is really the part that applies mainly to the individuals and the benefits that you may see and the rule changes that you'll see from these packages. So, next slide, Gene. So the big one is these stimulus checks that everyone's talked about, and they did get included in the CARE Act. It's a little interesting how they're structuring these, but these are actually called recovery rebates, as you'll hear them. But they will result in a check. So the way it'll work is individuals that make below a certain level, which I'll talk about here in a second, will get a $1,200 per adult check. And then families that have kids will also receive an extra $500 per child. And that's defined as a child under 17. So you have a child under 17 in your house, extra $500. There are phase outs or limits as far as how they're going to go about cutting these checks. So the way they'll do this is they're going to look at your 2018 tax return or your 2019 tax return. So if 2019 hasn't been filed, they'll look at 18. If it has, they'll look at 19. And if you make over $150,000 of AGI, adjusted gross income, on your return, your check will be reduced and it phases out. And for married folks, once it's over like 200,000, there's not much left. An individual, once you're over 100,000 or so, it's there's not much of a check left. So that's how the phase out part works, and you kind of get an idea if you may or may not be receiving a check. The interesting piece to this is this will actually be trued up in your 2020 tax return. So this is actually considered a tax credit on your 2020 tax return. And so when you go sit down with your CPA and you file 2020, they're going to take a look and see what was your income in 2020. And the nice thing is there is no clawback in this in the check. So what that means is if you end up making more than those phase out thresholds in 2020 and you receive a check because you had made less than that in 2018 or 2019, you will not have to give the money back. You get to keep the stimulus check. It's yours. There's no clawback in the rule. If you, and the example that I've ran across here recently is actually my brother-in-law and his wife. They just had twins. They're amazing babies, great. They had twins about a month ago. So for them in 2019, their return does not show dependents. It's just two married filing jointly folks. And so they're not going to get a $500 check for their kids this year. But when they go file their 2020 taxes, they'll have an additional $1,000 tax credit on their 2020 taxes for their two kids. So that's the true up part of the stimulus package. So really, they've designed this in a way that you're either going to benefit now or in April if you're under the phase outs. And some folks will get lucky, and if you're over the phase outs but you were under before, you'll still get your checks. So that was really far in the weeds on this, but if you guys have questions or kind of want to know what check you're getting or how that works, just feel free to reach out or let us know. So next slide, Gene. The other rule changes in the stimulus package was a few different things. The first one is the 2019 tax return deadline has been moved to July 15th. So if you haven't filed your 2019 returns yet, you don't have to till July 15th. If you're getting a refund, we still recommend you try and do that as soon as possible to make sure you get your refund. If you're not, just make sure you work with your CPA and keep us updated. We do like to get copies of those for any clients on the call. Required minimum distributions. That requirement has been waived for 2020. So no one is required to take a RMD in 2020. If you've already taken one, we will have an individual conversation with you about how that works. There's ways that we can likely send those back or not take it if we don't need to, but we'll have those on an individual conversation. So Corona-related IRA withdrawals. This is a very interesting one. There's a couple different nuances to it, but the big benefit is if you're under 59 and a half and you take money out of your IRA or retirement account because of a coronavirus-related need, then you don't have to pay the 10% penalty. That's been waived. Not something we're necessarily encouraging folks to do because you still have to pay federal taxes and state taxes on that money you pull out. There's some rules about how you can spread that on over 3 years, but if you're in a situation where you think you want to talk about that or explore that strategy, please don't hesitate to reach out. We can walk you through the pros and the cons. It's definitely not a slam dunk, but can explain why you may or may not want to consider doing that. For most folks, the answer will be you don't want to do it. Charitable changes. This one is small, but it's actually it could be a bigger victory down the road. So they're allowing a $300 charitable deduction, and you don't have to itemize to get that. So in 2017, they took away, or they changed itemized deductions a lot, so most folks weren't benefiting from charitable contributions. So now, if you write a $300 check to any charity, you can take a deduction. The reason this is big is because in the future, a lot of folks are hoping that this will open the door to them creating an unlimited charitable deduction above the line. So there's some weird tax planning and lobbyists going on there, but some people got a small toe in the door here with the $300 deduction. Student loan interest is waived through September 30th. If anyone has loans or has family members dealing with student loans, the interest is waived. Payments are also waived. And then HSAs and FSAs, you can actually now purchase over-the-counter products with those accounts for anyone doing that. So a lot of small nuances and rule changes. There's if you hear things, you're not sure, or have questions, please don't hesitate to ask us, because we know everyone's trying to digest this information as it's coming out, and we're happy to discuss your individual situation and how the specific rule may apply and if there's pros and cons to it. And with that, I'll turn it back to Gene.
Okay, just as a couple of reminders from our first section, our first blog, stop looking and obsessing. I think everybody's probably getting good at that, but there's just too much information out there. Some days it's good, some days it's bad. Asset allocation is the key to long-term success, not trying to time the market nor be a stock picker, because trying to time the market is futile. And a reminder, human innovation always trumps fear. We are hearing about all sorts of great things that are happening, although challenges are coming along. I read something today about a manufacturer who can make hoods that 3 out of 4 folks who need a ventilator could use a hood. Is it true? I don't know, but there's lots of stories out there. And then finally, from the first session, is time is our friend. As we saw, we'll get through this. We don't know when. That's the uncertain part. But time is our friend, and you're in the right place. Last week, just as a reminder, we talked about rebalancing for the long term. And that was part of our discussion, what I referenced today. We're not going to rush in, but you'll see us at some point begin to rebalance when we get some stability in the equity markets. We also talked about tax loss harvesting, taking losses that you can use in taxable situations from brokerage accounts, not from retirement accounts. And then we also talked about Roth conversions, converting traditional IRAs and paying the tax when those account values are down. So with that, I hope that there's some questions that we can answer, and I will attempt to Yeah, I think I can.
Gene,
Yes.
there is a question. Where do you think cash is safest? Since things have happened recently that we thought would never happen, do you think cash is safe in the bank?
Well, I'll take that one, and anybody else can respond, Clayton or Sharon. Yes, the FDIC guidelines are $250,000 per bank, but yes, cash is safe. The banks are in a much different situation than they were back in '08 and '09 when they were not capitalized enough. Capitalized means they loaned out too much money and they didn't have reserves. Those reserves in the banks are in much better place right now. If you've got a lot of cash and you're concerned about the FDIC limit and you've got 250,000 or more in one bank, you may go to another bank and put it in there. I think you're safe, but if it makes you sleep at night, then that's something you could certainly consider. And while we're waiting for the next question, I got all cocky and I thought we were really good at this, and all these great notes that I had are for the market update. I put them back up on the screen so that we can see them because I didn't put them up earlier.
And Jean, I think the next question might be Clayton. It is a question. It's if in 2018 you were over the limit for the check, for the stimulus check, but have not filed in 2019, and in 2019 and 2020 you're under the amount, would you qualify for the check?
Yes. So if you file your 2019 return fairly quickly, there's a good chance that they'll still cut the check. There's some uncertainty on, what date they're going to look at your return. And if your 19 return isn't filed at the time they're looking at it to determine the stimulus check, they're going to use your 18 return. So if you file the 19 return soon, they may use the 19 return, which would end up cutting a check. If they go off 18 and you're over the limit, you won't get a check, but on 2020, you'll get a tax credit. So you won't receive a check today, but you will receive a credit when you file 2020 taxes in 2021. So you get a benefit. It's just not an immediate benefit of a cash check today. So the rule is actually written in a pretty good way as far as, for the most part, people in 2020 that have, and I think it's going to be the case for a lot of folks. For a lot of folks that were making decent incomes previously and maybe had a reduction in income for some reason in 2020, which a lot of folks have experienced for various reasons, you may not get a check, but you still get a tax break that is very almost equivalent to the check. It just happens on your tax return instead of you getting a check in the mail.
Okay, I don't see any other questions right now. Does anyone want to raise their hand, and we'll open the mic and let you ask a question?
Don't be shy.
Okay, I'll ask a question.
Great.
So 60, going to be 67, have 401k regular. I don't have a Roth. So is there an amount that would be worth me considering converting to a Roth? Part of it, all of it, some of it? Is there a percentage that I should consider to convert to a Roth since the market's dropped so much? Or, I'm still working part-time for the next 3 years, probably till I'm 70. So I just was wondering if I should consider that Roth option with the percentage of my, since all I have is a regular 401k retirement.
I'll take that one, and anybody else can chime in, Sharon or Clayton. Yes, it's the big decision or the big factor, Keith, is what's your taxable income this year. So since you said you're working part-time, it's certainly something you ought to look at. And I'll repeat my example I gave last week. If 2 months ago you were thinking about converting $50,000 you can convert the same number of shares now for, say, $35,000. You would have paid tax on the 50 2 months ago. You'd only pay tax on the 35,000 now because the values have dropped commensurately with the market. And then the really good part about this is whatever's in that Roth account now, until you either take it out or you pass it along to your heirs, grows tax-free. So if that $35,000 grew to $100,000, your beneficiaries of that Roth or heirs would get that $100,000 tax-free. So absolutely, you ought to look at it, and it's really tax dependent. If you're working full time and in your high earning years, it's probably not a slam dunk. But if you're working part time or in retirement and your income, your taxable income's down, it's certainly something you ought to look at. I hope that answered your question. Clayton or Sharon, y'all got anything to add to that?
I don't. How about you,
Thank
Clayton?
you. I will talk to somebody probably the next couple of days about that. Somebody you know. So
Terrific. Other questions? Don't be shy. Well, while we're waiting for another question, please give us feedback on what we're doing. We are giving you information that we hope is useful to you, but if there are topics you'd like to see or hear about, please shoot us an email, give us a call, let us know what you want to talk about. We're always happy to talk about the markets, what we think they might do. As we said earlier, we don't know. We hope that there's some stability coming into the markets, but today was another down day. Who knows what tomorrow holds? But as we get more certainty around when this might die down and when we might get back to normal, that's when we see some real stability ahead of time, because that's what the markets are really factoring in, is how long is this going to take? Because as we mentioned in some of our previous chats, 70% of our economy is consumer spending. And we all know what's happening to consumer spending right now, except at the liquor stores and the grocery stores. It's fairly non-existent.
Jean, there's a question about any thoughts about the SBA loans, small business loans.
I'll touch on that. And then Sharon, I'm going to let you touch on that. Well, why don't you take that one?
Okay. We are actually looking into the small business loans, and you need to go through your bank, whoever you bank with, and get on there in their register and prepare all your information so that when they are available to take your loan application, you're set to do that. Those are a good opportunity for small businesses. Off the top of my head, it's people who employ under 500 employees, and you have the ability to borrow your payroll. So you're going to be looking at your payroll expenses, including some taxes, as well as some rent or mortgage interest payments. And there's a few things like that. I think health benefits and whatever you might pay into a retirement plan on behalf of your employees are all eligible for that loan. And then the really good part is the forgiveness portion, and that would be a separate application further down the line to be forgiven for up to 8 weeks of those payroll expenses, as long as there are some stipulations if you retain those employees on your payroll. And there's several things around that, and we'd be happy to work with anyone because there's just really a lot on the on that. But it's a great opportunity, and certainly any small business owners should be looking into doing that. So great question. Thank you.
Thank you, Sharon. I see a couple of other questions. Thank you for those. What are the risks of getting back into stocks too early? Is it more than just the chance of further decline? That's really it. There's a chance of further decline. You may be right, you may be wrong. And what's interesting about the question is the phrase getting back into stocks. So as we've talked about, asset allocation is so incredibly important. And if you had a correct asset allocation, you're in stocks already, but hopefully you're not in too many stocks for your risk tolerance and time horizon. So really the rebalancing part of that is getting back in. And yes, that would be the biggest concern is, are we getting in when there's further to fall or we're on the way back up? We just don't know. We can't time the market. So yes, that's a good question. Good, more questions. What sectors do you think will do well and which ones will lag as we come out of this downturn? I'll give my response and then Clayton and or Sharon, you do as well. I would say the sectors that have been hurt the worst, which would be energy, which would be consumer travel and spending, which would be the banks. Those are the ones. And what we do is we look at strong balance sheets, companies in those areas or those investments that have strong balance sheets that can weather the storm. Those are the sectors we think that will probably do well, are the ones that have come out that have had more of a downturn than others. Clayton or Sharon, y'all got any thoughts on that?
No, we do have another question that's off that topic. So if there's any more you want to say
I think Clayton was going to put his 2 cents worth in.
Yeah, I think, I mean, I echo what Gene's thoughts are, but I would just say that some of this, you know, is prudence to be impatient, because the more patience we have, you know, every day that goes on, we have more information, and there's so much unknown in the markets right now that when we choose to get into the market and choose a sector or choose a play, you know, as far as an opportunistic place we want to be, we want to make sure that we're taking a steady step. So, and there are a lot of unknown out here in a lot of these sectors, it's tricky. So specific sectors, it's actually kind of hard to call, because the banks right now, if you think about those, as Gene said, they've definitely been hammered. And on top of it, they've just been asked by the federal government to take on an incredible amount of work to try and work with all these small businesses and carry out the federal government's CARE Act. So what's the impact business-wise to banks? I think that's definitely still unknown. As Gene mentioned, the travel industry and entertainment and leisure, folks want to get back to doing those things, and there's going to be opportunities there, but who's going to be left standing at the end of all this, and how long does this last? How long of a storm do they have to weather? So, you know, I think there's a lot of things that we're weighing back and forth. And as Gene mentioned, I don't think there's a few that we know are getting beat up, but I don't think there's clear winners and losers at this point. And we don't want to be putting capital into the market immediately when we're not 100% sure where the best opportunities are. So
it's a target-rich environment right now for opportunities. Next question is, if you convert a Roth, do you have to wait 5 years before you can take some of those funds? Yes, you do. You have to wait 5 years or you would pay tax on the growth of that Roth conversion. So if you did a Roth conversion, that's a great question. Thank you for it. If you did a Roth conversion before you tap those funds, you'd have to wait 5 years, or any growth on those Roth funds you'd have to pay tax on. A Roth conversion is a long-term plan anyway. So yeah, great question. Next one, are the rules for mortgages on rental properties different than for home mortgage? I'll give my take, and then Clayton, you hop in here. They've always been a little bit different in that you can't create a loss, which is we're getting out of my field of expertise anymore, but you can't create a passive loss on rental properties. So there was some limitations before all of any changes that came out about mortgage interest. So I don't know about what changes may have occurred for rental property. Clayton, are you aware?
No, I think as you were mentioning, Jeannie, there's definitely some differences, but it kind of depends on the specific rule that you're talking about with the mortgages. Or the rental properties are handled differently, as Jeannie mentioned, from taxes and the lending side of it too. If you're talking about lending and refinancing, that's also a little different as well. So I think any time you're approaching a lender or approaching a CPA about this, make sure you specify if this is a rental property or your primary residence.
Great. Next question is, are there any advantages to taking money from your 401k and set up a 529 account for a grandchild? We are really against taking money from a 401k because you slow down the ability to grow that money tax deferred and moving it anywhere. There are certainly exceptions to that rule, and there are some slight tax deductions depending on what state you live in for a 529. We're happy to dig into that in your particular case, Keith, with you, perhaps on that call that you're going to schedule. But as a general answer, taking money from a 401k is a last resort. Do you have any information on the news about the self-employed being able to apply for unemployment benefits? Clayton, you got something on that?
Yeah, they can, which is really crazy. So that's a huge rule change. And so if you have someone in that specific situation, let them know, because let them know, just reach out to us. We can answer those questions. But the Georgia Department of Labor, if you go on their site, or South Carolina, all the departments of labor are now allowing applications for self-employed individuals just for this specific coronavirus period. So this isn't a permanent change. This is coronavirus related, and you have to answer the application correctly. But they are, and there's lots of stipulations around it too.
Great.
Let's see, Jean, we have one more question. Is this a good time to start 529s once the market settles?
Well, it's always a good time to start 529 plans, especially for the students that are going to go to school soon, because after putting 5 through college, it's tough. Yeah, 529s are a great idea. We're certainly in favor of those. We've always been of the mind, don't fund all of your anticipated education costs in the 529 plan, because you can actually overfund it and there can be some consequences to that. But we love 529 plans and think they're great for 2 main reasons. One, you can get a tax deduction in some states for putting those contributions in. And as long as those funds are used they're defined very broadly for educational expenses, that growth is tax-free. We said we'd hang around as long as we needed to, so we'll give you another minute or so.
Jean, Keith is asking next week. I guess that means next week. Will we be doing this?
Oh, yes. So thank you. Our plan is to every Wednesday at 5:30 host this video conference while we can't see each other. We've had a great response to it. Thank you for joining us. It makes us feel good that we can help. So yes, we'll absolutely do it again next week at 5:30. And as I said earlier, please send us your ideas of what you want to hear. We'll certainly use some of the questions that you've asked today. And at the risk of repeating ourselves, we might repeat some things that we've talked about because we think they're really important.
And we do have one more 529 question. Do you get a deduction for 529s for grandkids?
Clayton?
It depends on the state. 529s are run based on state rules, but most states that have tax deductions for the state allow a deduction for any beneficiary. That's typically anyone you choose, a grandchild, a cousin, yourself, whatever you want to put money in there for.
Well, I know you're tired of looking at me, not at Sharon and Clayton, but we thank you again for joining us. We thank you for the confidence you placed in us. If you're shy and you didn't get your question in, please just shoot us an email, give us a call. We can talk on the phone too, or we can schedule a Zoom meeting just like we're doing now. We'd encourage clients and folks who want to talk to us. This is a great way to communicate because we can pull up information as we've done here with our PowerPoint. So with that, be safe, take care of each other, give somebody a call who you haven't talked to in a while. Communication is really important, and you just never know what it might mean to them. So again, thank you for your confidence. Take care of yourselves and wash your hands.